Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. We are back with our commodities guru, a man who needs no introduction, Rick Rule. Rick, thank you for coming back on the show.
Steve, thank you for having me back on the show. I enjoy these discussions.
I do as well, sir, and so do all our listeners. Okay, let's start out like we always do. And what is your macro view of the world economy and financial markets?
That's a big question. We don't have enough time. Let me begin by saying that I continue to be cautious. I continue myself to run large cash balances, despite the fact that I understand that at today's interest rates with today's inflation, that holding cash imposes a cost, which is to say a negative real interest rate. I continue to hold gold bullion because my belief is that despite the near-term appearances of rosy outlooks, that gold is a wonderful form of insurance. And at age 70, I've become fond of insurance. I am continually impressed with the strength of the U.S. economy in the face of the idiotic governance that we enjoy, if that's the right phrase, and in particular, in the face of higher, at least nominal interest rates. I am continually impressed that the individual initiative of individual Americans, their genius, their tenacity, their hard work, is sufficient to fund our collective stupidity. I'm delighted, by the way, that that's the case, although I am certainly surprised. I believe that the Fed, contrary to some people's opinion, has a real concern about inflation. I don't think it's lip service. I think they understand that Congress is never going to reduce the debasement of the U.S. dollar, never going to reduce spending. So it's going to be up to the Fed to save us from a 1970s style runaway inflation. I believe that their orientation and the strength of the economy will allow them to raise interest rates at least 2 more times. While I am impressed with the strength of the economy in the face of interest rate rises, I wonder if we won't face a delayed punch. I notice, as an example, that the interest payable by young families on 30-year fixed mortgages has doubled. I notice, too, that volumes in single-family home transactions have stalled, meaning that the buyers look at the interest rate and find houses less affordable, but sellers cling to pricing expectations that were set 2 or 2.5 years ago. It is this gap between the bid and the ask that I think has slowed down transactional volumes. And I think that the market has to break one way or the other, up or down. My bet is down. The fact is, my bet shouldn't matter because that's not what I do. While I am, in fact, a lender, or as I would describe myself, a used money salesman, I am proficient in conventional financial services and in natural resources. I wouldn't describe myself, as an example, as a home builder. So take what I say with caution. I look at the relatively attractive pricing around both natural resources and precious metals, and I continue to be adding to my position both places. I have lately been bottom fishing for community bank stocks, which have been absolutely tossed out as a consequence of the fairly well-publicized problems around bigger banks. I think investors always toss the baby out with the bathwater. They look at narrative rather than arithmetic, and I try to do the other thing. And I continue to believe that absent a recession, I'm not saying that we're going to have a recession, but absent a recession, the whole commodity complex seems very cheap. I want to reiterate, too, for your listeners, that almost irrespective of what we do, we are going to run into a supply cliff in some of the major commodities in the 5 to 7 year time frame. If we don't have a recession, we're going to run into that supply cliff quicker. I say if we don't have a recession, you can have supply shortfalls in the face of reduced demand and still have no price impact. Irrespective of a recession, in 5 years, I think we'll begin to experience fairly severe shortfalls in some basic commodities like copper. The consequence of that is that investors, and by the way, copper users and fabricators should position themselves now. I hope that helps.
It does. It does. It certainly makes us feel better with the cash position, and that you're still going with gold bullion. What's interesting about what you said is the market right now has priced in as far as the Fed increasing interest rates only one more time, but you're thinking they're probably going to do two.
Yeah, understanding that my crystal ball is cracked and cloudy, Steve.
Okay.
I'm talking, I'm not an economist. I'm a used money salesman. I'm amazed at the strength of the U.S. economy, given the interest rate challenges and given the idiotic imposition of American power and will abroad. The fact that we're deliberately disenfranchising former trading partners, the fact that we're deliberately weaponizing the dollar and therefore weakening the dollar as a reserve currency on a global basis. I'm astonished, in fact, in the face of all of the efforts by our government to destroy our economy, that our economy is so strong.
Yeah. Yeah. Okay. Well, we have an opportunity to learn from the expert in person. You've got the Rule Symposium in Boca Raton coming up. I'm not going to be able to make it in person. I've got my folks coming into town that week, but you have a live stream event where you will be able to watch this over the internet. Can you talk to us about that, when it's coming up, and what we can expect on the live stream?
Steve, I'm excited about the whole conference, but I'm particularly excited about the live stream. We've put on this conference now, I'm informed, for 23 years, interrupted, of course, by COVID. And one of the difficulties was always that there were a lot of people who would like to have attended the conference, but couldn't. It was inconvenient for them to come from where they were to where we are. Some for reasons like yours that were personal, others because they lived far away, and it was just too tough to come. The technology has saved us. And this year, you can come to the Natural Resources Investment Symposium either in person, which of course I would prefer, but if not, via technology, via live stream. In either case, you will have access to recordings of the entire conference, live if you wish, or delayed. I have found myself, we're going to offer you 50 or 52 hours of programming in 4 days, which is to say we are going to work your behind off. And having the ability to review the tapes after the event for 6 months is absolutely critical. The technology associated with that allows us to avail investors of the conference in real time, wherever they are, in the comfort of their home, which is really important. We're really looking forward to being able to bring this educational event to more people in more places. So let's talk about the event itself. In the first instance, our conference for 20-something years has had great big picture gurus. People like Jim Rickards, people like David Stockman, Bill Bonner, Grant Williams, Nomi Prinz, Daniela DiMartino Booth. These are pictures who can describe the world as it is, not as the big thinkers wish it were. And this gives you paradigm that isn't available in the global media. It's important, I think, that you understand alternative views with regards to the way the world is. If you agree with that worldview, and that choice is yours, of course, we present it to you. If you agree with that point of view, we have analysts and portfolio managers around natural resources and precious metals, because that's all we do, who have been in the business successfully for 30 or 40 years. Not people who learned to spell uranium after they failed in marijuana, after they failed in crypto, after they failed in technology that they couldn't spell or understand, but rather people who have been in the business for 3 or 4 decades, through thick and thin, through bull market and bear market. That's important. More importantly, though, Steve, we have a group of entrepreneurs that we call the living legends, people who have built multi-billion-dollar natural resource companies from scratch. People who talk about the lessons that they learned building these multi-billion-dollar companies and how it made them better investors. and how you can be a better investor yourself. And in particular, we make these guys name names. What companies do you like that you aren't part of, and why? It's fascinating to learn who they invest in, how they invest, and why they invest. Beyond that, unlike any other conference I'm aware of, the attendees at our conference have told us that the exhibitors are content too. They aren't just advertisers. At most investment conferences, the qualification to be an exhibitor is a check that cashes. That doesn't work with us. An exhibitor at our conference, a public company exhibitor, must be owned and accounts owned or managed by the sponsors of the conference. Now, Steve Stadley, not every stock I buy goes up. There's no guarantee of that, but there is a guarantee that we know the companies that have exhibited with us well enough that we are shareholders of them. You get a vetted, curated experience. We're confident enough, Steve, of the value that we offer that anybody who attends the conference, either live, virtually, or frankly, anybody who attends any of our boot camps or buys any of our investment education related products enjoys a full gold-plated money-back guarantee. If you attend live or in person, and for whatever reason you think I didn't deliver you full value, I don't want your money. Email me, I'll give it back. So irrespective of how you choose to attend, either coming down to the Boca Resort, which I would, of course, prefer, one-on-one in person is just, it's really nice. And the resort, by the way, Steve, I mean, I know that you can't come this year. I don't want you to feel jealous, but Michael Dell's got $1.4 billion in this place now.
Wow.
And I got to tell you, it shows 245 acres in downtown Boca Raton, half a mile of oceanfront. A room in the tower normally sells for $1,300 a night. We backed him all the way down to $300 a night. Pretty good fight there, by the way. So it's a spectacular circumstance, but I absolutely positively understand that life gets in the way, that it's inconvenient for folks to come to Boca. And as a consequence of that, we pulled out all the stops with regards to technology. We're going to deliver this thing live to your computer. Our conference will be your computer or your phone, anywhere you are in the world. And if for some reason you don't think that we have delivered sufficient value, don't pay. I pay.
I love that. I'm really looking forward to it. And I like the fact that it's recorded. So just like with your boot camps, you can go back and watch it again, which I've done many times.
Steve, that's really important. You know, I put these things on and I know most of the material and I know most of the presenters and all this kind of stuff. And I play them 3 or 4 times. Even I, the producer, if you will, can't absorb all the material that's available in one sitting. I just can't do it. And so it's absolutely critical that people not only be offered this, but in fact that they take me up on that offer.
Yes. Yes. There will be a link down in the show notes where you can sign up. If you can do us a favor and support the show, use that link if you're going anyways. And Rick has been nice enough to kick a little bit back to the show and keep the train running. So thank you. Okay, getting on to listener questions. I'm going to abbreviate some of these names just for my own sanity here. Annie asks, now, Rick, keep in mind you're going to be speaking to about 15,000 pseudo man children here are going to be hanging on these next words. How would Rick prepare his child to succeed if they wish to follow in his footsteps?
Well, first of all, I would hope that they followed in their own footsteps as opposed to mine. I'll tell you some of the things that have worked for me. It's trite, but if you can afford to, follow your passion. I understand that some people just need a job to pay the bills. That's okay for a while. I did that. But over time, you succeed in life based on your ability to serve other people's needs better than other service providers. If you are doing something like I have done for most of my life, which you would do for free if it didn't pay so well, you will outcompete other competitors. You make money by delivering value to other people. That's the end of the equation. Figure out what you can do to serve the customer that you know and love and trust in a subject that you love in a way that delivers that customer more value than your competition, and you will succeed beyond your wildest dreams. I did okay working for money. When I stopped working for money, when I started focusing on delivering value, within 3 months, my income began to soar and my satisfaction increased absolutely exponentially. The next thing is invest in yourself. Tell these children that they need to invest in themselves. Knowledge is what gives you the ability to compete. And knowledge, by the way, can't be stolen. Only the product of it can be taxed. In my case, I'm 70. I guess some of it can be lost. But the truth is, invest in yourself. Read, read, read. It's important that you do this. I'm very fortunate in that studying and learning are recreational for me. I can't get enough. And I'm not suggesting that, every young child should be some freak like Rick. All I'm suggesting is that if a child is taught how to learn and taught the importance of learning, that he or she will outcompete the vast majority of their peers who haven't learned those same lessons. Your most important asset after your knowledge is your brand. Be the person that you want to be. Don't take shortcuts. Don't lie. Don't cheat. Don't steal. Be who you would like to be seen. You are writing your epitaph as you're living. And it is your own brand and your knowledge that will determine the opportunities that you're able to avail yourself of. So I'm sorry if that sounds very grandiose and, some form of pontification, but it's all true. I've lived it for 70 years. And by the way, I have at one point in time or another, skated too close to the edge on all those. So this is the voice of experience.
I like that. Follow your passion, serve other people's needs, and deliver value to your customers where your competition isn't. Invest in yourself by reading and learning. And what I hear you saying is establish your brand and make sure you're authentic.
Yep.
Yeah, I like that. Okay. Jeffrey Spalding. Rick is the cream of the crop. I'd like to know Rick's steps 1, 2, and 3 on making a valuation of a company to determine a fair price of their current assets.
That's a question that is far too long to address in the time that we have available to us. But it is a question that I plan to address in a 3 or 4 part series at the Rule Classroom. Understand that there's no one size fits all for valuation. The valuation metrics associated with risk-adjusted net present value and exploration, as an example, are very different than the tools that you would use in valuing a mature company like BHP or Exxon. I hope to give people an introduction to valuation in a 3 or 4 part lecture series upcoming in the Rule Investment Classroom. I warn you that this will not be an entertaining course. This will be very, very, very hard, very similar to my cross-border taxation workshop, which people described as about as exciting as chewing concrete.
Okay. Yeah. If you guys are not on his classroom series, I'll put a link down in the show notes, Rick. It is amazing and free content. Okay. Let's see. Long-term investor. This is from Blaine. I understand at this time miners are the redheaded stepchildren of the markets. My question is, what techniques does Rick use to hold fast his position on mining equities that have not changed their story, but in fact issued good drill results, yet Mr. Market ignores them? Does he double down, avoid news, and go on vacation?
Well, 2 things. The first thing is that I have a memory of that. This is not my first rodeo. I've been through good markets and bad, as you can tell by looking, for a very long time. And I have a patience that's born of experience. I I have learned that particularly with regards to speculative mining investments, which I assume is what the questioner is referring to, when I look back at my successful and my unsuccessful trades, my real successful trades, the 10 baggers, the 20 baggers, the 50 baggers, have almost all required a 5 or 6 year hold. And almost every one of them has delivered me a 50% decline in share price at some point in time during the time I held it, which means that you must be both patient, very patient, and persistent. If you form an opinion as to a company's value, and if you understand the path that the company can take to increase that value, what happens when the company adds value to the understanding of its asset, but its share price declines, is that the company is becoming more rather than less attractive. If I see a company and I believe it's worth $1 a share, and I believe that there's a reasonable possibility that in 18 months it'll be worth $2 a share, if I can buy that company for, say, 70 cents a share, a slight discount to what I think it's worth now, but less than half of what I think it's likely to be worth 18 months from now. And if they don't disappoint me, which is to say, if the news continues to validate my thesis, and the price of the stock falls from 75 cents to 35 cents, the stock just became twice as attractive. Arithmetically, it hurts my feelings, perhaps, but my feelings are not how I make my money. If I am buying what I think is $2 worth of potential for 35 cents, that's better than buying it for 75 cents. Double down if you have an understanding of the facts and if the facts haven't changed or if they have improved. Conversely, if you find you're wrong, if you think it's going to go to $2 because X, Y, and Z are going to come true, and X turns out not to be true, sell the stock. When the reason to own a stock goes away, the stock has to go away. If you bought it for $1, it's now selling at 70 cents. It may be worth nothing. Losing that first 30 cents beats the hell out of losing 70 cents. So when the reason to own a stock goes away, the stock has to go away. No ifs, ands, or buts, irrespective of price.
Okay. Treat it like tuna fish.
Right. Many don't know the reference, but we'll do that again someday.
Yes. All right. Moving on to uranium. From Prac. Question. Kazatomprom getting cozy with Russia. Perhaps new sanctions. Will companies like Uranium Energy Corporation with domestic American operations benefit? If so, can they produce at current spot price, or do they need the price to climb up?
The analysis that we have done internally, privately on UEC suggests that they make fairly good money at $60. Okay. Now, the questioner needs to understand that the current spot price of uranium is $56, but more and more transactions are taking place in the term market, which is opaque. Yeah. And the pricing that we're seeing in the term market is substantially above spot, which is to say about $60. It is my belief that Uranium Energy can generate a fair amount of cash at $60. The company has wisely decided that they're not going to restart any substantial amount of production until they have enough of that production contracted to credit quality buyers so that they can generate a reasonable return on equity employed. The first part of the question, I guess, involves around the possibility of U.S. sanctions against Kazatomprom as a consequence of their Russian activities. I have no idea just how stupid the U.S. government proposes to be. I would remind the government, if they listen to me, that who Kazatomprom does business with is Kazatomprom's business, which is to say they do business with us, despite the fact that we have forward bases in over 100 countries. They do business with the Chinese. They do business with the Russians, as they should. I'm a Kazatomprom shareholder, and I believe that talking to your customers, irrespective of your customers' like or dislike for each other, is something that you owe shareholders. If they chose to get more cozy with the Russians, and if we chose to punish them for that, I suspect that would ultimately benefit in the near term UEC. Whether or not that occurs is highly speculative.
Okay. All right. Yeah, we're getting a lot of questions on the bifurcation that's been happening since the war. Um, okay. Ivania, does Rick think we will see any acquisitions from state-owned entities like Orano or CNNC, China National Nuclear Corporation, during this uranium cycle? And if so, which companies does he think they would find attractive for a buyout?
I absolutely think that you will see increasing interest in uranium assets, producing assets, or advanced development assets by state-controlled firms and also perhaps by the independent power generation industry. I think the most logical buyer would be China General Nuclear. And I think in the case of assets that they will buy, I think that they'll look primarily at African assets, where the state of China, their government, is most supportive of the industry through bilateral trade agreements. I think that you will also see increasing Chinese participation in Kazatomprom on a project-by-project basis. But if you're looking at the most probable M&A transactions by a state-controlled firm, I think Chinese in Niger, Namibia, Botswana, Tanzania, Kenya probably represent the low-hanging fruit. The Chinese understand their need for uranium. The Chinese are doing, by the way, precisely what the United States did in the 1960s and 1970s. They have an industrial policy that involves ensuring access to the raw materials needed to run their economy, both in terms of state action and in terms of private investment. So they're copying our playbook, and they're doing it better than we do now. I think you'll see other kinds of consolidation. By the way, I don't think that you will see China General Nuclear allowed to invest a substantial amount of money in the Athabasca Basin in Canada. My suspicion is, particularly now that Teck is threatened with a takeover by Glencore, that Canadian nationalism will raise its head. And to the extent that somebody is allowed to buy those Canadian crown jewel assets, it will either be a foreign multinational active in Canada like BHP, or more probably it will be the Canadian champion Cameco, or should Teck continue as an independent company, Teck. I don't like the idea I don't like the probability that somebody like NextGen or Fission would be able to be bought by Chinese interests, despite the fact that they're strongly supportive existing shareholders.
Yeah. Okay. And that goes right in line with the Belt Road Initiative that they're trying to establish right down in Africa.
Right.
Okay.
Just what we did. Just precisely what we did.
Yeah. Yeah. All right. Okay, we got a couple of questions on your exit strategy for uranium stocks. I asked Warren Irwin about this, and he maybe 6-8 months ago, and he said, once you start to get about 200 junior uranium companies, you should start to rethink your position. What is something that you're thinking about for your exit strategy?
I think for somebody who, and by the way, Warren can and will do the work. I think he was providing a rule of thumb for people who don't do the work.
I think you're right. Yeah.
And I mean, my own work is done on an evaluation basis. When I value uranium junior, I run a $75 case because I think that's the incentive price for new production. If the uranium market went to $70, and if the junior met or exceeded my own net present value calculation for that company at $75, I'm likely to be a seller. I miss the blow-off tops, which means often I miss the precipitous declines that follow them. What Warren says, though, merits real consideration. I remember the last uranium bull market. As you know, I remember it fondly.
Mhm.
At the beginning of that market, uranium was at $8 a pound, and the incentive price was about $30 a pound. I remember thinking in my mind, well, the price of uranium could go to 40 because of tightness. Well, I was wrong. It went to 140. At the beginning of that bull market, there were 5 uranium juniors worldwide that had survived a 20-year bear market, and they were all good. They were all tough. The truth was that there were probably 12 or 15 management teams in the world at that point in time that were capable of running a uranium junior, and there were 5 aspirants. So the probability that you had a good management team in your uranium junior was a function of dividing the number of teams, let's call it 15, by the number of aspirants, let's call it 5, which means that the probabilities were that your company was well run. By the end of the bull market, the price of uranium was $145 a pound, and the incentive price was something like $50 a pound. The price didn't have to go up anymore. But more alarmingly, the number of aspirants, which is to say the companies that were or pretended to be in the uranium business, was 500. But the number of management teams was unchanged. So the arithmetic suggests that the probability that you had a good management team running your uranium junior was a function of, once again, dividing the number of capable teams, 15, by the number of aspirants, 500, which meant that there was overwhelming probability that your company was run by somebody who 5 years previously could not have spelled uranium. And the outcome was, predictable.
Yeah. Yeah. Okay. All right. Let's see. Got a question here from Leonard on the SPUT. Sprott Uranium Fund can only issue units when it's at a premium. Is there anything stopping the fund from issuing units to large fund managers who are interested in putting their money into Sprott, even if there is no premium?
As long as the institutional investor invests money at or above net asset value, the answer is that there's no restriction. And that has happened. There have been people who have subscribed through the at the market plan at above market prices. And that remains open. That mechanism exists today. It's a function of how myopic I think the investment market is, that a commodity that almost certainly has to go up and can be bought at a discount to NAV isn't being bought. There was a time not too long ago when the Sprott Physical Uranium Trust sold at a premium to net asset value. It is solely a function of perspective, and what I would argue is the myopic view of many investors and speculators.
Yeah. Yeah, we've been dollar cost averaging into this one because it's been a discount now for a few months. It's been awesome. I mean, at times it was 16 or 18%. I think last I checked it was like 9. But I get questions all the time. I'm like, it's a good deal.
The other thing that people need to recognize is that it's more heavily discounted than people know. 3 years ago, the spot market had 80% of the transactional volume in the uranium business. We calculate NAV at spot, but the truth is now over 70% of transactions are taking place in the term market.
Wow.
And the term market is priced higher than spot. So when you see a discount between the Sprott Physical Uranium Trust and the so-called market for uranium, you're getting a double discount because spot is a discount to term and SPUT trades at a discount to spot.
70% is done in the term market?
That's the current estimate. Yeah.
Wow. Okay.
Yeah.
I learn something new every day. All right. All right. What is Rick's favorite uranium company in each of the following jurisdictions? Africa, Canada, and the US.
I don't have a favorite one in Africa. I own several in Africa. Understand that they are all risky.
Yeah.
meaning they are all, at least the ones I like, in development or exploration stages. But I own several in Africa. As you know, I like taking early stage risk if I understand it. Canada's a no-brainer. Cameco.
Chemical.
I'm not trying to say it's the one with the most upside. I'm saying that is the one with the best juxtaposition of upside to downside. Many uranium juniors are talking about their resources in terms of tonnage and grade, where if that rock was controlled by Cameco, they wouldn't even report it.
Hmm.
So there's a lot of optionality in Cameco at higher uranium prices, which people don't understand, but they do just fine right now. Cameco, too, being in Canada and listed on the New York Stock Exchange, is the first name that the generalist investors will go to when uranium regains the narrative that it enjoyed in the last market. In the United States, I have to say that while I think UEC is fully priced relative to $56 spot, that they have done a wonderful job of assembling ready to produce permitted assets, both in Texas and Wyoming. I think they will be accorded, and I think that they deserve a premium for their permitted U.S. assets. Trying to permit a new mine in the United States is really a hellacious endeavor. I think, too, that when you look at UEC from a speculator's point of view, the fact that for 20 years they spent millions of dollars on financial public relations means that they have a 90,000 shareholder constituency. There is no group of buyers in the world as eager for good news as existing shareholders. And I think if that shareholder base gets incented to get excited about that stock, the shareholder constituency which other juniors hope to build is already established at UEC. So from a speculator's point of view, who also has a geopolitical bent, I think that you need to look at UEC.
Okay. Canada, Cameco, US, UEC, Africa, no favorite.
Yep. Lots of opportunity, though.
Okay. Okay. Let's see. We've got, let's do this one real quick. What are Rick's thoughts on whether next gen could be bought out, or do you think they'll go into production?
I think they'll be bought out.
Okay.
I think they need to continue to act as though they're going to build it. I think you need to continue to de-risk the project. I think they've done a good job with the benefit agreement for the indigenous people. I think they've done a good job with the environmental work that they've done, the permitting that they've done. I think ultimately that given that the upfront capital cost there, it's in a very remote part of Canada. You know, it's 300 miles from nowhere.
Mm-hmm.
They'll hate me for saying that, but it's true. That the capital costs associated with that, including, power and logistics and camps and stuff, it's going to be a multi-billion-dollar exercise. The idea that it wouldn't be built in conjunction with fission seems silly to me. There's been enmity between the two management teams, but I think eventually saner heads need to prevail. Now, that might not happen. You'll remember in the Canadian diamond industry that two different companies built two different sets of infrastructure, 25 kilometers apart from each other, when they were collectively 800 kilometers away from any other infrastructure. It may be that stupidity triumphs over economics in the uranium business too. But I think that when the next gen deposit gets built, it will likely be built in conjunction with fission. And I don't think it'll be built by the current management teams of either. I think, however, that patient shareholders of either will do fine in that circumstance.
Okay. Okay. 5-year time frame?
Your guess is as good as mine.
Okay. All right. Okay, we got one from Lost Cause Dave. I'm going to try to summarize this a little bit. Basically, he's asking about if we go into a recession, a liquidity crisis, as far as gold. So if we look back at 2020, COVID, gold just tanked and then shot right back up. Same kind of thing. 2008 great financial crisis, tanked and then shot right back up. Dot-com bubble, it was a little bit more of kind of like a U-shaped recovery. What do you see happening, assuming the Fed doesn't nail a soft landing? How do you see this one? Is it going to be a 2008, 2020, or do you think it'll be more like a dot-com recovery?
No, I think that, well, people need to understand. There's there's a group of people who believe that in an economic crisis, gold does well. In a liquidity crisis, nothing does well.
Okay.
The sales take place not by the investor, but rather by the margin clerk. And the margin clerk doesn't care what assets you like or what assets you don't like. They care about what assets have a bid.
Yeah.
Gold always has a bid, so it gets whacked. I remember in 2008, gold held up for 24 hours, maybe, and then went the way of everything else. What happens is that good assets come back more quickly than others. And the liquidity and durability of gold, I mean durability in terms of its place in the market, means that gold comes back. I believe, because of watching the government for 50 years, that the Fed response to a liquidity crisis will be to add lots of liquidity. Adding lots of liquidity, which is to say lots of phony dollars, lots of QE, artificially low interest rates, all of those things are good for gold because they all diminish faith in the US currency. If the liquidity crisis is dealt with by adding liquidity, artificial liquidity, I think that you'll see gold come back more quickly than it has in the past, and I think that you will see it outperform the past. I wouldn't discount, by the way, the Fed's chances of engineering a soft landing. I don't think it's going to happen, but I regard it as a contingency that I have to think about in terms of managing my own affairs. I'm very impressed with the strength of the US economy. I'm very impressed, too, with the ability of the government and the big thinkers to manipulate the discussion about inflation. And a soft landing, as they might define it, would be the perception among the populace that the interest rate offered in bank deposit accounts and near-term treasuries was exceeding the rate of inflation, which is to say that the rate of return on savings was positive. If you look at their inflation target, which is 2%, and you look at the current deposit interest rates at good banks, 4.1, 4.2%, or in the 12-month treasury market at 5%, you could argue that that's a 3% real rate of return. I would argue with that assumption because I think that the CPI is fraud. When it suits them, they don't include food and fuel. Steve, if you look at me, it's pretty obvious I like to eat. So food and fuel doesn't work in terms of my own calculation. But probably more importantly for me, the CPI, which masquerades as a cost of living index, it's not. It's copy. It's like advertising for newsletters, actually. The CPI doesn't include tax. Tax, in terms of most households' cost of living, exceeds shelter, food, transportation, and energy combined. And the idea that a cost of living index that doesn't include the cost of government seems very odd to me. I've said on several people's shows, if I didn't have to pay the tax, I guess I wouldn't bitch quite so much about the index. But my own belief is that the basket of goods and services that I consume, if that's the right phrase for tax, is depreciating the value of my own savings between 8 and 9% compounded. So I sort of believe, irrespective of the blandishments of the Congressional Budget Office, that the value proposition offered up to me by U.S. Treasuries is, if I buy the near-term Treasury, the 5, I get 500 basis points or 5% in interest in a currency that's depreciating in terms of the maintenance of my purchasing power by at least 8% compounded, which is to say I'm guaranteed a negative rate of return for 3%. Not very attractive to me. But I understand, too, that I don't make a market. I understand that the increase in the yield on short-term treasuries in particular has made those treasuries more attractive to some investors and savers than gold. I don't agree with their calculation, but that notwithstanding, I don't make the market, they do.
Okay. I hear you saying if there is a liquidity crisis like that and gold falls, that's the time to buy more.
I'm not going to tell your listeners what to do. Their circumstance and their patience and their means might be different than me. I will back up the truck.
Okay. All right. You and me both, sir. Okay. Quick thoughts on platinum before we get into the portfolio review. The World Platinum Investment Council last quarterly report reported a deficit of about 1 million ounces this year. And to put that into perspective, we're pulling out of the ground about 7.1 million ounces, but the demand they forecast is going to be 8.1 million ounces. So it's not like there's a whole lot of this stuff. A lot of it comes from Africa and Russia. How do you feel about platinum in 12 months to 5 years?
I own platinum as a speculative asset. Let me be more specific. I own the SPUT Physical Platinum and Palladium Trust. At age 70, I'm through buying physical big heavy bars and lugging them around. I don't do that anymore.
Okay.
So I own it through the SPUT Physical Platinum and Palladium Trust. And I own it for two reasons. One, despite all the talk that you hear about electric vehicles, the world runs on internal combustion engines. And platinum and palladium are necessary components in catalytic converters, which reduce the emissions from internal combustion engines. You don't see a whole bunch of popular support for more smog, which means that demand for platinum and palladium will continue and, in fact, grow as a consequence of the continued dominance of the internal combustion engine. That's the demand side. The economics are also sterling. It takes about $125 worth of platinum to make a catalytic converter work that enables the sale of a car for $40,000 or $60,000 or $100,000, meaning that if the price of platinum doubled, the price of a car wouldn't go up at all. It would be inconsequential. That's lovely. It's the supply part that interests me as a speculator. I gave you the investment case. The supply case is what drives me crazy as a speculator. Platinum comes really from three places. It comes from South Africa, where both the political and the sociological regime is imploding.
Yeah.
The South African platinum mining industry, which, while it has improved notably under Neil Froneman, is still a labor-intensive circumstance where the laborers are not paid anywhere near enough, but where the industry continues to be labor-intensive because the political scene in South Africa is so chaotic that labor can't be replaced by capital. Literally between a rock and a hard place. Beyond that, of course, platinum is produced in Zimbabwe, which makes South Africa look like a holiday park. Yeah. And then the other source, which used to be a sort of a paragon of stability, is Russia. So your supply comes overwhelmingly from South Africa, Zimbabwe, and Russia. The possibility of a supply disruption, I'm not saying the probability, I'm not saying the certainty, but the possibility of a supply disruption is spectacular. And the price move that you would see in the face of a supply disruption, when you could easily double the price of platinum without changing the product price where platinum is the constituent, drives me crazy. I mean, it absolutely drives me crazy. I love it. Will this set of circumstances come to fruition? I don't know, but I can't help but play it. I see relatively limited downside, and I see the possibility of excellent upside, not the probability, the possibility. And if you give me the probability of a pretty good return, relative in particular to the very, very, very low probability of a loss, attractive to me.
Here's a visual graph of what you're talking about. South Africa, Zimbabwe, and Russia. these are the ones where it's coming from. I mean, that makes up almost all of it,
Yep.
going into there. And if we have a disruption, my God,
Uh,
especially in that one.
of course, it's important to consider recycling, which is a very important source of supply too.
Yeah, that's represented by this
Yep.
kind of
Yep.
middle
Yep.
shaded one right there. Yeah. Okay. All right. Okay. All right. You ready? Portfolio review lightning round. We had submissions of over 100 companies. If your questions was, or if your company was not included, do not fret. Simply go to the link down in the show notes, ruleinvestmentmedia.com, and Rick will personally rank your portfolio, 1 being the best, 10 being the worst, and include any thoughts that he believes are pertinent. All right. You ready, Rick?
Yes, sir.
Okay. Royalties. Royal Gold.
Royal Gold, I have just upgraded to a 4. I had it as a 5 because of the concentration of royalties they had on a few projects, one of which was underperforming. I've upgraded Royal Gold to a 4 from a 5, partially because of better diversification of income, partially too because of a share price decline, which made this company simply more attractive all on its own.
Okay. Sandstorm.
Sandstorm, same thing. I had it as a 5. I was disappointed with their capital allocation. I note, however, that the Hodmodden deposit is about to come on stream, which will markedly improve the fortunes of Sandstorm. And in the same fashion that I had punished Sandstorm for their capital allocation decisions, the market had punished them too. So not just because of improving fundamentals, but rather also because of declining price, I've upgraded it from 5 to 4.
Okay. Gold Royalty Corporation.
Gold Royalty Corporation, I have at 5. I like their ability to unlock value, but I believe it's fully priced. What I like about Gold Royalty is the unusually aggressive and competent nature of their management. The fact that they are increasingly transactional and have an ability to add value to their existing royalties that doesn't exist in some other companies, but it is fully priced.
Okay. Miners. Kinross.
Kinross is under review right now. I traditionally have not been a fan of Kinross because of capital allocation decisions. I need to say, though, at current prices, I'm in the process of reviewing Kinross.
Okay. Pan American Silver.
Pan American Silver, I downgraded it from 3 to 5. I'm upgrading it from 5 to 4. I haven't done that yet, but I'm just in the process of working through that. I was disappointed, I guess is the right phrase, with the Yamana purchase. They doubled the shares outstanding to buy a bunch of assets, which was certainly accretive on a per share basis with regards to cash flow, but it diluted my interest in the undeveloped Argentine asset and the non-producing Guatemalan asset, which is to say, it diluted my shareholdings in about 1 billion ounces of high-grade silver, which bothered me. Bygones are bygones. The market punished them severely. So the discount has been taken up by the market at the same time that I understand that it is likely that Pan American is about to prevail in Guatemala and be able to return that asset to production. If they're able to do that, their free cash flow probably grows by 40%.
Oh, it's going to come back online.
Yes, that's what I understand politically, that they are very close to reaching an accommodation with the regional communities and also with the central government. The central government would love to be able to have this thing back online, but for domestic political reasons, they have to pay attention to their constituency in the far north. And my understanding from Guatemalan sources is that a regional consensus is fairly close to being arranged.
Okay. That's good news. One of the two is hopefully coming back. Okay. Sibanye Stillwater.
Sibanye Stillwater, I've downgraded from 4 to 5. Neil Froneman has done a spectacular job at Sibanye Stillwater, but the internal circumstance in South Africa gets worse and worse. And a substantial amount of Stillwater's assets and their free cash flow comes both from gold and platinum mining in South Africa, where circumstances beyond Mr. Froneman's control are conspiring to make his life much more difficult.
Okay. First Majestic Silver.
First Majestic Silver, I have moved from 4 to 5. I love the leverage to silver. I love the team's ability to take aging assets, pump some love into them, and increase them. Unfortunately, they stubbed their toe so far very badly at Jarrett Canyon. And until they can show me a turnaround at Jarrett Canyon, irrespective of the optionality in silver and irrespective of my fondness for Keith and his team, I need to stand aside.
Okay. Fortuna Silver Mines.
Fortuna Silver Mine, I've upgraded from 5 to 4. My concern around Fortuna had to do with their ability to operate outside of their host terrain in South America, and their ability to build at nameplate capacity a mine in Africa on a remote basis. They've done that. You'll recall that their last mine effort in South America, rather than being a narrow vein, high grade deposit, was a high altitude open pit deposit. And they stumbled badly with regards to that effort, which made me wonder if they had the capability of building outside their area of expertise. They had now have that asset turned around, and they succeeded in on time, on budget, nameplate capacity construction in Africa, which tells me that they now have the capability of doing that. And the stock is cheap.
Okay. Minera Alamos.
Minera Alamos, I don't know enough to comment.
Okay. Getting into explorers, BlackRock Silver.
BlackRock Silver, I don't know enough to comment.
Okay. Seabridge.
Seabridge is an optionality play. I have it at 5. Given that I'm a bull on the gold market, I normally in my own account would have it as a 4. I'm also very impressed with Rudy Frank, who has become, among other things, a personal friend. I note that it's no longer a pure optionality play in the sense that they aren't just holding the deposit. The consequence of their agreement with the Tahltan First Nation in British Columbia means that they've had to begin substantial pre-production work, and they're going to have to spend about $150 million over 2.5 years. Every dollar they spend, of course, reduces my optionality at the same time that it de-risks the project.
Nice copper up there too.
Nice copper.
Okay. Oil, Blackstone Minerals.
I love it. I have it at a 4. I probably should have it at a 3. If I came to understand on a sort of a asset by asset basis the company better, I would almost certainly upgrade it. The problem is that there's not enough of me to go around in terms of study.
Okay. Echo Petrol.
Don't know enough to comment.
Okay. Copper, Arizona Metals.
Under review right now.
Okay. Ivanhoe Electric.
Ivanhoe Electric is fully priced based on the assets that they have now, but Robert Friedland companies are always ahead of themselves in terms of price. The work that they've done, in particular in Arizona, is extremely impressive. The upside that they have in 3 or 4 projects around the world is impressive. And the potential, which I can't assign value to because I don't understand it, of the technology that they have in iPulse.
Now, is Ivanhoe Mining and Ivanhoe Electric, are they
different companies?
Yeah, okay.
Different companies. I have Ivanhoe at a 5. I own it personally. So sometimes my own actions are different than what I tell other people to do. I'm willing to take more risks than most people are. So while the identifiable assets in the company on a net present value basis don't make the company a screaming buy, the intangible asset, which is to say Robert Friedland, the unknown asset, which is to say the iPulse technology, and the incredible results that they've delivered to date means that it has a place in my portfolio, if not in my recommendation.
Okay. And got a lot of people asked about Trilogy.
I no longer own Trilogy. I've downgraded it from 4 to 6. High grade deposit, wonderful guy running it. I mean, a wonderful guy running it. but it would appear that they have an implacable foe in the form of the Biden administration.
Okay.
And, you have to drive a road across a lot of federal land to get there. And being crosswise to the Fed is not a good thing in that regard.
Yeah. Okay. And last one on uranium, Boss Energy.
I have it as a 4. I own a substantial amount personally.
Okay. All right. Awesome. Well, thank you very much, Mr. Rule. This was a pleasure. Really looking forward to the symposium, and I will be there over the live stream. Do you have any final thoughts or anything you want to say before we close out?
Well, one final thing. People who didn't get their questions answered with regards to their companies are invited to go to ruleinvestmentmedia.com, list your companies, and I personally will rank them. And as you have said, comment where I think my comments might have value. In addition, I would love to see anybody around come to the symposium, either physically or virtually. Finally, any of your listeners who are unhappy with their current bank might consider my new bank, Battle Bank, at ruleinvestmentmedia.com. Under questions and comments, simply say bank. And finally, if you're an accredited investor and you care what I do with my own money in private placements, I'll tell you for free.
Eric, Benjamin.
Enter placements at ruleinvestmentmedia.com. As you can hear, my phone's going crazy, so I have to sign off.
All right.
Thank you.
Thank you very much, Rick. You have a great rest of the day, sir.